I think you may remember in early March, I wrote a piece called "A Drunk Man in the Snow," and I talked about mean reversion and the fact that the 35 plus year bond rally had not ended yet, and that the downtrend was solidly in place. And until we had something that would indicate that we were breaking that trend, that our expectation should be that rates should come back down. And there's some other factors that I talked about. The Treasury was going to spend down its cash balance, which was going to force a lot of cash into the market, which would force banks and other institutions to have to reach out the yield curve to find any kind of yield. And so, it seems to have all played out that way.
And so is that who's doing the buying in your mind? Is it the big Wall Street banks? Is it pension funds? Is it foreign sovereigns?
I think it's all of the above. There's a lot of money coming in from overseas. We are still, perhaps the highest yielding market in the developed markets. There's pension fund money that has to be put to work. We manage a lot of insurance company assets, and flows coming in from insurance companies, especially for fixed annuity products, is exceptionally strong. And so, it's amazing. The little guy out there is, who's wanting to make sure they have some income for retirement, are trying to lock in something now, because I think they're afraid that they could get to a point where they're not getting paid anything.
You still think we could end the year where 1% or at least under 1.5%?
Yeah, I think we will, and easily under 1.5%. We're sitting here around 1.25. I put out a tweet this morning that, we are reaching some technical levels here where we probably, need to, start to think about what the longer term view is. But I just did some charts before I came in the room, and I don't really see any significant resistance for the continuation and the decline of yields until we get to 1%. And then I don't think that's that significant. Meaning, there is a support for yields that they don't go lower, but it's not exceptionally strong. And technically, it looks like we're going back to the lows, which would be 65 basis points.
Wow. Is there some maybe hidden risk to these rates, Scott? And I don't want to get too in the weeds, but things like mortgage convexity, right? Corporate bonds, things that are tied to rates that we may not be aware of. Is there any under the hood risk to these levels?
Well, first off, the convexity argument, Brian. If anything, mortgages are going to prepay, which that money has to get redeployed again, which will put downward pressure on rates. The seasonals at this time of the year are very favorable for bond yields or bond prices, if you will, to see them go higher. And then, of course, there's always what I would think of as the exogenous factors. But before we go there, I remember Alan Shaw, who I studied technical analysis with back in the 80s, and he is the great dean of technicians. And he told me a story about how he, once working as a fundamental analyst, had an older mentor, and they did a call with a company, and they said, the response of the CEO of the company was, it couldn't be any better. And they hung up the phone, and the older analyst instructed Alan to write a sell report. And he goes, why would we write a sell report? And they go, it couldn't be any better. And that's the case with the economy. It couldn't be any better. And so if it can't be any better, then, things will be slower in the future, and growth will start to slow down. And then the base effect on inflation will start to show reducing inflation. And candidly, the market just hasn't been set up for that, and investors haven't been set up for that.
It's an interesting anecdote. So is that a risk to equities? People think of you as a bond guy, but you can do whatever you want, really. There's a point at which some people say, well, low rates are great for tech stocks because the valuations can stretch. But is there a rate on yields that suggests that things, to your point, are risky and are bad for equities. What do you see for stocks?
Well, trees don't grow straight to the sky. And we've had a great run here. And, Ned Davis Associates has done a lot of work in this area. Their work shows that we should expect in the second year of a bull market that we would get something like a 16 to 18% correction. The seasonals in stocks have turned negative at the end of May. The old adage of sell in May, go away. And so, I think people at this stage of the game are pretty fully invested. So you have to wonder where the next dollar is coming from. And so I think that we are prone to seeing a setback in stocks. But, I want to be careful, Brian. The current valuation of forward earnings of about 22 times on the S&P is just about fair pricing based upon where long-term rates are. If long-term rates are continue to fall, we have room at some point here to see another leg up in stocks. And if you believe Ed Hyman's estimates of a $250 S&P earnings number, you put a 20 multiple on that, the S&P is at 5,000. So I think we're even though we may soon have a correction, and I think it is coming, we are a long way from the end of the bull market.
So fair to say, short term, maybe next couple of months, seasonality, Ned Davis research, look for a possible correction in equities. Long term, you are still bullish stocks as long as rates stay where they are or even move down. Fair to say?
Fair enough.
Now, it's not just your rate call that looks good. A couple months ago, you made a call on Bitcoin. Just again, you're not some crypto expert, you don't claim to be, but you're looking at the charts. And you said Bitcoin is prone for a 50% retracement. I believe that, Scott, that's exactly what we got. So congratulations again on that call. Any view on cryptos now, because the interest seems to have waned?
Well, I think, when I did my work on crypto, Bitcoin and other cryptocurrencies had plainly just gone parabolic. And parabolic markets are impossible to sustain. So, a normal correction you would think or a sell-off would be, 40 to 50%. But, when we look at the history of crypto and we look at where we are, I really do believe this is probably a crash. And, a crash would mean we'd be down 70 to 80%, which let's just say that's between 10 and 15,000. Mm-hmm. Brian, the market is trading heavy. It's very hard to get this thing to reverse. And I don't see any, reason, put it this way, I wouldn't be in a hurry to buy Bitcoin. And I don't see any reason to own it right now. And I think the risk is, if you're going to be a speculator, speculate that it's heading lower.
Shepard Smith here. Thanks for watching CNBC on YouTube.